Welcome to The Explainer. In this video, we're going to break down a powerful concept from ICT that's designed to help you find much better buying opportunities.
Okay, let's just start with something I know drives a lot of traders crazy. You see the market is rallying, you feel that FOMO kicking in, you jump in and buy, and then almost immediately the price just reverses and goes screaming in the other direction. So why does that happen so often?
Well, according to ICT, the solution requires a pretty major shift in how you think. You gotta stop chasing price like everyone else and start thinking like the big institutions, the ones that actually move the market. And they do things differently. They wait very patiently for a discount.
So that brings us to our first section, thinking like the banks. This whole idea is about shifting from chasing price to hunting for value. And it all starts with spotting one very specific type of price move.
The first thing we need to be on the lookout for is what ICT calls an impulsive price swing. Now, this isn't just any old move up. We're talking about a strong, clean, really aggressive rally. It's a huge clue that a ton of money just entered the market and its intention is to push prices higher. So that big impulsive swing creates a range, right? From its low to its high. And here's the key idea. Institutions see this range in two really simple ways. The top half is what they call a premium market. It's expensive. The bottom half is a discount market. That's the bargain. And as buyers, we should only be interested in shopping in that bargain bin.
And we can see this really clearly on a chart. That 50% level, the halfway point of that whole swing, is what ICT calls equilibrium. Think of it as fair value. Now, any price above that line is considered a premium. As traders who are looking to buy, we should basically just ignore that whole area and focus only on prices when they fall below that line, down into the discount zone. Okay, so how do we turn this concept into an actual method we can use? Well, that brings us to our next section, finding high-probability discounts with a simple step-by-step process you can start using right away.
The framework itself is actually pretty simple. It all starts when you spot that strong, impulsive swing up. Then, once it kind of peaks and starts to turn down, you just measure that entire range, from the low to the high. And from there, your only job, and this is the hard part, is patience. You just wait for the price to trade back down into the bottom half of that range before you even think about placing a trade.
And what's really brilliant about this is that it's not a one-time thing. The market is fractal, which means this pattern repeats over and over. Once a move from a discount zone plays out, a new impulsive swing often forms, creating a brand new range. And, you guessed it, a whole new opportunity to wait for another discount. It's like a repeating cycle. Now, we can get even more precise. You see, inside that big discount area, ICT points to an even smaller, high-probability sweet spot. This is where some of the most explosive moves tend to kick off from. This is called the optimal trade entry, or OTE. This special zone starts once the price has retraced at least 62% of that initial impulsive swing. This is where we need to start paying really close attention, because we're getting into a very deep discount area now.
So why is this OTE zone so powerful? Well, as ICT puts it here, when a market is genuinely bullish, it will not hang around at these deep discount prices for long. The smart money sees it as a total bargain, and they're going to step in fast. And that often causes a really sharp, dynamic move higher. And here is a perfect example. You can see price trades right down into that OTE sweet spot, somewhere between the 62% and 79% levels. It barely touches it, and then it just rallies away aggressively. It doesn't waste any time. That speed is a massive clue that you're probably on the right side of the institutional flow.
But what happens if the price doesn't stop there? What if it keeps on dropping and even takes out the low of that first big swing? Now, this is a really crucial point, because what looks like a failed trade to most people is often something else entirely.
Yeah, a lot of traders would see this and immediately think the setup has failed. They'd assume their bullish idea was totally wrong, and they'd probably panic sell. But ICT teaches us to look at this specific event not as a failure, but as a potential high-probability setup all on its own.
This move is often an engineered stop run. The big institutions are deliberately hunting for that pool of sell-stop orders that they know is sitting just below that old low. So, in a bullish market, when you see price dip below a key low, only to quickly snap back and trade higher, that is one of the strongest buy signals you can get. It's a huge sign that liquidity has been grabbed and the real move is just about to start. So, let's wrap all this up. This is your new trading framework with all the key takeaways you can start applying today. So, the bottom line is this: stop chasing price. Just stop. Instead, your job is to identify that strong, impulsive swing up and mark your 50% equilibrium level. Then you have to patiently wait for the price to come back to you, into that discount zone. Ideally, you're looking for an entry in that OTE sweet spot between 62% and 79%. And remember, if you see a dip below a previous low, don't think of it as a failure. See it as a potential stop run, which is a massive buying opportunity. Your greatest tool in all of this is patience. We really hope this video helps you see the markets with a little more clarity. If it did, please like this video and subscribe to the channel. And if you have any questions at all, just leave them in the comments and a human representative will get back to you. Safe trading.